Hello and welcome to Moneylife News and Views. I am Debashis Basu. In the mutual fund business, where there are already 45 players, another new elephant has entered the scene. And a lot of people think that this new elephant is going to trample over everybody else, or as the current favorite term goes, they will disrupt the business. The new elephant is none other than Jio Financial Services, which is a demerged entity from Reliance Industries. It's going to list very soon. Reliance already has got through a session by which the demerged company has been traded on the site to discover the price and so on. Now, Jio Financial Services will do a lot of things. One of the things which it will do, and for which it is tied up with world's largest, absolutely the very largest fund management business, with almost $20 trillion of funds under management, and that is BlackRock from the US. Now, very little is known about Jio Financial Services, but already people are talking about as if it is just going to be, taking the entire industry, the mutual fund industry, by storm. Please remember that a lot of large companies, international companies, have come and gone, and some are still struggling to make a mark in India. They are not among the biggest, whether it's Templeton or Fidelity or BlackRock itself, which had earlier come with GSP and had gone away. Can Jio Financial Services and BlackRock, now that Mukesh Ambani's entire might will be behind it, do something significantly different? Now, to quote BlackRock, they're going to transform India's asset management industry, democratize access, whatever that means, to options for Indians, delivering affordable and innovative investment solutions. Affordable and innovative, well, we'll see, because already mutual funds are quite affordable. Innovative is not very easily possible because it's a highly regulated business, but we shall see. A lot of people say that this new entity is going to disrupt the business. But what is disruption? And why are we suddenly talking about disruption? That is because human beings tend to see a pattern, even if there's a sample of one. Didn't Reliance disrupt the telecom business? And so they're going to disrupt the mutual fund business. It's a leap of argument, leap of logic, as it's called. But remember, Reliance Retail also was supposed to disrupt the retailing business, but it is just another large retailing enterprise. It has not crushed anybody. It has not disrupted anybody. Now, what is disruption? This is a term that we talk about all the time, but many people seemed not to understand that disruption is a very, very specific term. It was coined by the late Harvard professor Clayton Christensen, and he had coined this to explain a very specific kind of a trend, a well-defined trend in a specific industry concept. Now, what was this? He said that disruption is when there is a very large business, 2-3 people dominate the business, and then suddenly there is a challenger. But the challenger is at the low-tech end of the business. They probably find a niche, a particular unmet need in this entire gamut of the solutions that the dominating companies are offering. And they find a way to supply that unmet need. Low tech, low cost, and so on. And so the big guys are not bothered. However, that solution, which is the low tech and low end of the spectrum, turns out to be very big. It keeps growing and growing and growing, and these companies, these are small companies, the challenger companies, suddenly start making a lot of cash. And with that cash, they manage to upset finally and destroy the business of the dominators and take over the industry. Now, none of these factors apply in case of mutual funds. It's not that Reliance is coming at the low tech and low cost end and so on and so forth. I mean, you can very clearly understand that. The big reason, one of the biggest reasons why this business the mutual fund business is completely different from any other where a lot of innovation is possible, because it's a highly regulated industry. And there are 3 reasons that come in the way of massive demand creation as opposed to any other consumer products. One mutual funds cannot launch whatever they want. It's not a consumer product, it's a regulated product. They need each time to go to SEBI and get a permission. Point number 2, they cannot have any marketing gimmicks. They cannot make false claims like many consumer companies seem to do. And mutual fund companies cannot use celebrities just as the consumer companies to do. So obviously there is a huge limitations in terms of your ability to market yourself. Second, there is no natural demand pull for mutual funds. It's not that you get up in the morning and say, hey, I want to buy a mutual fund. Like you think you would probably want to buy a cell phone. And so, as I say, mutual funds, like insurance, are sold. They are not bought. Right? And mutual funds by definitions are market linked products, which means that many times the performance or what the consumer, or in this case the investor, is supposed to get is not in anybody's hands. So it will go up and down with market cycles, and if there is ever a prolonged lull, and which happens from time to time, it's the most common thing in the stock market. It's not that year after year you're going to see the bull run that you're seeing now. At that time, in the period of lull, investors start getting bored. They start comparing their returns with mutual funds. With fixed deposits. Remember, in India, the largest investment product of choice is fixed deposits, where you get about 7.5% fixed. Now, in any 12-month, 18-month, 24-month period where you are not getting 7.5%, 7% annualized, investors start getting fidgety. They do not have the patience, they do not have the understanding, or very few people do actually have the understanding to see that if you have 3 bad years, it's time for a very large bumper year, which is around the corner. They don't think it like that. They pull out the money. Now, 4, demand for mutual funds are generated by distributors. Now, distributors also are regulated by, not directly by SEBI, but by Association of Mutual Funds of India. Now, no one can throw money at the distributors like consumer products company can do. They can give higher incentives to the dealers and push out products. You can't do that in mutual funds. Whatever money you have to pay is within the band which is prescribed by SEBI. So therefore, the cross-selling, people are talking about a lot of cross-selling opportunities. So many lakh people are subscribers of our Reliance retail consumers. So many millions have Jio cell phones. So there is cross-selling. Well, there is not going to be a cross-selling opportunity because of all of these constraints. Now let's move on to the supply side, which not many people think about. But supply side is really what makes or break a business. Most often companies think of what they are going to do, that is the inside out thinking. Very few people do outside in thinking, which is let us see what others are doing all the time. Now this is why from time to time in any sector there is sudden overcapacity, because everybody is thinking I only put up one more plant and I only supply so much and I only need another 1.5% of the market share. Everybody starts thinking like that, and when there is demand, when the going is very good, obviously they will all end up creating an oversupply. Now, what's the supply situation in mutual funds? There are about 45 people already, and Zerodha, Bajaj Finserv, and of course Jio are going to enter very soon. Of course, financialization is growing, and India's investing population has to grow a lot. Assets under management as a percentage of GDP is very low. It can grow a lot, but there are a large number of players to take advantage of this opportunity. It's not just 1 or 2 people like in petrochemicals or oil refinery or whatever. Now, Jio's Financial Services, and therefore Jio Mutual Fund, is supposed to harness. Today everybody talks of machine learning, artificial intelligence, big data. There is no press release without these 3 words. Now, all of these sounds complete mumbo jumbo to me, because the key issue over the very long term is outstanding investment performance. While mutual funds are difficult to sell, one of the positive things about mutual fund, unlike any other product, unlike many other products or most other products like consumer products or even insurance, is that you get to know the performance straight away. Within a month, within a year, within 3 months, even you can slice and dice the performance in any way you want, and there's nowhere to hide. The better guys come up to the top, their performance shows, and you can check and put money. There's hardly any other business where you can actually showcase your performance and attract money on that basis, but that doesn't quite work. The reason why it doesn't quite work is, as I said, go back to the earlier point I made, which is that the business is made or broken by distributors. And because the largest distributors are banks, the top 3 mutual funds in India are all large private sector banks with great footprint, which is Axis, which is ICICI Bank, which is HDFC and State Bank actually. State Bank, ICICI and HDFC Bank, and Axis also comes within the top 7. Well, no machine learning, no AI, no technology is going to help unless your fund performance is top notch and you have fantastic distribution strength, and so far the banks have a lock on that distribution. Now, while the Jio press release talks about BlackRock's deep expertise and talent in investment management and risk management, product excellence, access to technology and so on, BlackRock's own funds are not among the best in the US. Why not? You would ask yourself. Because at the end of the day, performance variations are very minor. They invest in the same sort of stocks, they stay invested 100% most of the time, they go along with the cycles and so on and so forth. It's very, very difficult to do something different. And if Reliance or BlackRock knew something significantly different in terms of how to manage investments, they would do it on a proprietary basis. And they wouldn't put it in a public retail fund business with just about 1% fee. Of course, there's a lot of speculation that like Jio, like Zerodha and others will launch passive funds. Now, passive funds which really follow an index such as exchange traded funds, but they are low cost products and you need massive volumes to be able to break even. Passive products are enormously popular in Western countries, mainly in the US, but not so in India because mutual fund distributors have very little interest in pushing passive products because they make less money. So you see, I have listed down so many issues, so many hurdles in the way of any mutual fund coming in and disrupting the sector. It's not easy. As I said, it's regulated, demand creation is difficult, investment expertise is more or less similar, and so on and so forth. How do you stand out? So in short, all of these hurdles will prevent Jio from disrupting. Of course, it will grow very rapidly in size. I have no doubt about that. It's going to be large very quickly, but to disrupt the sector, I'm not sure. If you like this, please subscribe and share. Thanks for watching.